Installation hardware is down 52% year to date and they report earnings on June 12th. In this video, I'll give you my 1 year and 5 year price targets, show you key technical levels to watch and explain under what conditions I'm ready to buy. RH isn't your typical furniture retailer. It's a high-end lifestyle brand selling luxury home furnishings, lighting, textile, bathware, and more. They operate expensive RH galleries, run restaurants inside some locations, and publish massive source books. Their membership program sells exclusivity and experience, aiming for high margins and loyal, wealthy customers. They also expanded internationally with galleries in the UK and Europe. For fiscal year 2025, RH generated about $3.18 billion in revenue, marking moderate 5% growth over the prior year. In the most recent quarter that ended in February 1st, 2025, quarterly revenue was $812 million, showing 10% year over year growth. This comes after quarterly highs near $992 million in mid 2022, but reflects a slowdown in top line momentum as the luxury consumer environment becomes more cautious. The stock trades at a forward PE of approximately 18.9 times and a trailing PE near 52 times. They reported EPS around 3.62. Analysts forecast a 12-month average price target of about $272, suggesting around 44% upside. However, caution is warranted. Using my valuation model, I project a 1 year price target of $240, which is about 31% upside from roughly $189. Over 5 years, if RH delivers on its luxury positioning and margin recovery, I see potential for $718, which would be a 291% gain. Technically, RH is trading below all of its key EMAs and near a support zone around $150. Waiting for a bounce toward the 200-day EMA near $230 could provide a solid swing trade entry point. To push the stock higher, RH needs to tackle three fundamental areas. And the first one is their inventory management. They currently have elevated inventory, but reducing it would free up cash and ease margin pressure. Clearing seasonal or slow moving inventory can boost margins. The second one is their debt reduction and free cash flow. With high debt to EBITDA around 6.2 times and only about 30 million in cash, RH needs to generate stronger free cash flow. Paying down debt is key to improving creditworthiness and freeing up capital. And the third one is their tariff risk mitigation. Roughly 70% of their goods are sourced from Asia. Ongoing or new tariffs could hurt margins. Transparent updates on supply chain strategies or sourcing diversification would go a long way. Analysts highlight liquidity strength with current ratio of 1.4 times and manageable short-term obligations, but long-term debt and inconsistent cash flow remain key concerns. Here's what could derail the thesis. The first one is luxury consumer slowdown tied to macroeconomic conditions like housing market weakness or high interest rates. And the second one is tariff and geopolitical risk, raising production costs, potentially forcing price increases that could advertise customers. And the third one is elevated debt and low free cash flow, limiting flexibility or triggering re rating downward. Insider selling and aggressive past buybacks funded through debt also introduce governance risk. It's critical that RH proves it can service debt while growing organically and not just rely on financial engineering. Here's where I stand. I currently do not own any RH shares. I want to see the tariff situation resolved and inventory levels improve. If the $150 to $160 support zone holds, I'll begin scaling in for the long term position. My plan would be to buy on strength towards $230 and hold for the next few years, targeting the mid $700 if business fundamentals recovers and margins improve. To recap, RH shows moderate revenue growth around $812 million quarterly, which is 10% year over year. Valuation is reasonable with forward PE, but debt and margin pressures are concerning. Price targets looks attractive, 31% upside in 1 year and 291% in 5 years. Key improvements needed are inventory reduction, debt reduction, and tariff risk mitigation. I'm watching for stabilization at $150 with a swing entry to $230 before building a core position. Let me know in the comments below. Are you cautious about RH or would you buy the dip? Do you think $240 is realistic? If you like data driven stock predictions, hit like, subscribe, and check out the stock prediction series where I share full breakdowns. Let's invest mindfully and build long term wealth together. Thanks for watching, and I'll see you in the next video.